Hello there, welcome to the Weekly Show Ahead. We're in the middle of earnings season and so far earnings have been relatively decent with the majority beating expectations, but those expectations were dramatically lowered. And it's the same story for next week as well, where we anticipate earnings from Britain's biggest banks, European banks, oil majors, US tech giants and some of the largest car companies as well. But first, let's get to those economic data releases and see what's scheduled for the beginning of the week. As you can see just there, we've got TTIP negotiations. It's the 13th round. That's a transatlantic trade deal between the US and the EU. Plenty of other UK releases as well on Tuesday. It's another busy day for the economics because we start with the UK once again and three notable US ones, including goods orders and services as well, and consumer confidence. On Wednesday, we start in Australia for the inflation data. More from that area of the world, with New Zealand as well reporting. And the crucial ones, though, are the UK GDP and the US Fed rate decision as well. We are going to concentrate on those. And Thursday, it will be the Bank of Japan with their interest rate decision, Germany unemployment in there as well, and the US GDP. On Friday, Germany retail sales involved in there. More from Spain with Spain and Italy as well, and the Eurozone unemployment rate too. OK, so as I say, there are two big data releases coming up, but we've also got UK GDP as well. So we've got the US Fed decision, GDP from the US as well, durable goods and UK GDP. Where should we start, Chris? Because it's a mammoth week.
It's a huge week, mostly on the earnings front, but we do have quite a bit of key economic data coming through. We start with that UK. That's that first reading on GDP, on the economic growth rate for the UK for the first 3 quarters of 2016. Remember that the first reading of GDP only has about 30% of the data of the final reading, so it's very much not a guesstimate, but it's based on incomplete information. So whilst it carries a lot of weight, we shouldn't, I think, get too carried away with it. Nonetheless, a stronger reading than expected, and it's supposed to be actually slightly weaker than we think, but if we do get a slightly improved reading, you could see a bit more strength come through in the pound, because the pound obviously has been hit by these Brexit concerns over the last couple of weeks. Really, it's been quite a volatile day yesterday, and we've recovered some of that ground. But if you can see from the chart there, just the last 4 days we've been butting our heads up against this 144 level, which is actually, that was the high in late March as well. So this is the big one to watch. If you get a breakthrough there in coming days, and if GDP backs that up, you might actually see quite a bit more upside for sterling, certainly against the US dollar.
And while we're talking about GDP, we've also got stats coming out from the US as well, haven't we?
So this leads us to the other side of the equation, and again, US GDP not going to be great for the first quarter according to estimates thus far. So again, that could give the pound a bit more upside if you do get a better reading if you do get a slightly worse reading from the US and slightly better reading from the UK. And that of course leads us on to the Fed decision we get next week, which is
this is the huge piece of news that everyone's going to be dominating.
It is and it isn't in some ways, because they're not expected to raise rates. If you look at the Fed fund futures market, they're not expected to move at all. There's some indications, though, you could see a move in that direction later in the year. Firstly, money supply is picking up, which is a sign that the economy is better than we thought. And it's this sort of game of chicken between the Fed and the markets at the moment. The market thinks the Fed won't raise, but if they do start to move in that direction, you could see conditions tighten, you could see the dollar go up, you could see equities go down, and then that, whilst shouldn't influence the Fed too much, it might make them think, but clearly people are still worried about the rate increases. What does that mean for the economy? And it could cause the Fed to row back again. So it's just this back and forth between markets present. If you look at the US dollar index, the dollar basket on the IG platform, it has stabilised in April. Again, that 94 level, we were there earlier this year, we're back there again. That was a big support level. We're just back to the highs of the month thus far, 95 on the dollar index. And if it breaks through there, you can see it tried to do that about a week or so ago. If it does break through there, you might have quite a bit more upside, particularly if Janet Yellen and her Fed colleagues are quite hawkish, if you like, on the outlook. There's no press conference this time round, so we just get the decision and the statement that goes with it.
So we'll be analysing the body language, the words, for any clues for future rates. But as we say, we're not actually expecting anything on Wednesday. All right, let's move on and talk about the corporate data then, shall we? Because it is a mammoth week. We have got tons to talk about. Here we go, there's Monday, and that's actually a modest start to the week. Halliburton there, just there. So moving on to Tuesday. As you can see, it's getting busier. We've got BP, which we're going to analyse in just a minute. Standard Chartered, it's a busy week for the UK banks. We've also got stocks as well, the tech stocks with Twitter and Apple involved as well, and eBay Wednesday. We've got Barclays, as I say, UK banks, Facebook in there, Boeing, PayPal, and pharmaceuticals as well, GlaxoSmithKline. Mitsubishi as well, that's been in the headlines, hasn't it, as well, for the emissions. All right, Lloyd's as well, just there, Tullow Oil as well. We're always going to be talking about the price of oil. Amazon, Deutsche Bank in there, Domino's Pizza, Ford too, as I say, big week for motors as well. And here we go, Friday, RBS in there and Porsche too, and Eni. So lots of energy companies, lots of everything really. I mean, let's just be frank about it. Where do we start? Should we go with BP first?
It's a key one, quarterly earnings coming through for BP. And of course, it's not really about the low oil price this time around. We know that's in the price. We know that BP will have had a tough quarter, both in its upstream division, which is the exploration, the oil and gas element, and its downstream division, which is the refining part of the business. So both parts quite difficult to really find anything positive. But it is going to be the outlook for BP more than anything else, I think, this time around. You've had a stabilisation in the share price over the last 3-4 months. If we look at the longer term trend on this chart, you can see how 2015 was a year to forget for BP shareholders, but we've stopped going lower. We got to about £3.20 in the last half of 2015, and again this year we didn't go much lower than that, maybe for a day or so in 2016. So the share price trying valiantly to push up. Now the key question here is, are BP shares overvalued? Do we think the oil price is stabilising? And if they are trading at about 28 times earnings, is that too high, given maybe there's still slightly uncertain outlook? And don't forget, they've still got a dividend yield of 7% here, and that's way above the FTSE average. So there's a question there about the dividend. Do they start to rein back on the payout? Do they keep going with their job cuts to keep cutting these costs to make BP leaner? That has a problem further down the line, of course, because if you cut back on your operations heavily now in order to save money, if and when the oil price does turn and start to move higher again, your ability to capitalise that is slightly reduced because you haven't got as many fields as you did. And that's a question for BP's board and for shareholders over the longer term. But for now, in terms of the share price, we'd like to see it getting back to sort of £3.80. That was the sort of high right at the beginning of February, the end of January, and onwards to about £4 a share, because you can see in 2016 thus far, if we zoom back in again, yes, we got up to about 380 at the beginning of Feb, but since then upward progress has been lacking. We are above the 200-day moving average, which is a good sign in one sense. It does tend to suggest that the price is more likely to go up than down, but it's all about these earnings, and if the quarterly figures come in ahead of expectations, you might get a bit more upside in BP shares.
Okay, and hopes are high that the worst is behind them with BP. I want to talk about British banks as well, because there is tons. We've actually got Lloyds, Standard Chartered, Barclays, Royal Bank of Scotland and HSBC as well. Now, they've all been plummeting, actually, haven't they? All sorts of reasons, fears of negative interest rates involved with this, China concerns as well, and concerns about the US investment banking industry as well. So it's been pretty dire, hasn't it? It's
again been a year to forget for the sector, really. If you look at the chart over the longer term, we were up at, this is the IG sector trade. If you look at this, you can find it on the platform if you look for FTSE sector indices. And that's obviously the downward trend there. We're capped again by that 100-day moving average, that orange moving average on that chart there. We've got Standard Chartered this week, HSBC the week after, but both of them will be in focus further at Asian exposure, of course, because they did well in the good years out of Asia, and it's now been much harder. We had Standard Chartered downgraded yesterday by UBS. With US banks, it's all about the exposure to energy, how much they've lent to the energy sector and how bad that is on their performance. And that was the key thing that all these big US banks were fessing up to last week. Not so much the case with UK banks because they don't have such a big exposure to the energy sector, but it's a question of really how is it feeding across. And you mentioned those lower interest rates, that's hitting their net interest margin. That will impair performance. And if you look again at the chart, this is for the sector as a whole, you can see how we've had another bounce in the downtrend. The question is now, is that it? Do we roll over in the next couple of weeks? And that's quite possible, I think, given where we've been before. You can see every time we get up to this 100-day moving average, that coincides nicely on the chart there at the bottom, the stochastic index, with these sort of peaks. And if that rolls over, I think then you start to look at banks on the short side once again. But certainly next week, 4 of the 5 big UK listed banks coming through, and it will be the make or break moment, I think, for this rally, which has done very, very well over the past 2 or 3 weeks.
All right, let's switch gears and talk about the world's most valuable company, which of course is Apple. Now, actually, the times are changing for Apple, because it seemed like at one point they couldn't put a foot wrong, could they? And actually now we've got iPhone sales going down. This is a major concern considering it accounts for about 70% of their sales. Apple is almost its own worst enemy because it has been so successful in the past.
When you're the top dog, there's not really much room to the upside. I think that's the problem with Apple. The story got better and better for so long, and now the question is growth in China slowing? Is saturation being reached in the US? And that may well be the case. So we'll be looking to the segmented breakdown in revenues, also how their new product launches have been doing over the last few months, if they can spin a good story there. But still, Apple, it does look maybe a tad overvalued at the moment. Maybe it's still possible that we see more downside in the share price. If you can get a bit of upturn from this point, you can see it's pulled back the last week or so, actually sort of out of step with the broader market. But that brings us back nicely to the 100 to the 50-day moving average. So if you can see some support developing around the $106 a share level, roughly where we are now, actually you might start to see a bounce. So Apple's performance is key really in the outlook for the rest of the year. Where do they see their sales coming from? Do they see China's performance improving? That will be a key to determine the direction of the stock in the short term.
Okay, and on to the biggest social media giant that there is, Facebook. In the last 12 months, it has grown 35%. That's pretty impressive. What can we expect next? More growth?
And there's an awful lot of good news baked into that share price. The assumption is that, and they have done very, very well. They solved the problem of monetizing ads, which Twitter noticeably hasn't done. They've still got user growth. Facebook's monthly user growth is about 3% now. That doesn't sound like much, but it's about 43 million people a month compared to Twitter, which has a user base of about 30 million people all told. So it really is quite a big difference between the two. In terms of Facebook shares, we're stuck below those all-time highs we saw in February, March and April. And I think if we can't get back above there, the risk is that we just start to disappoint. I think we just start to see maybe a bit of weakness creeping back into the share price, at least in the short term. But it is dominant. It is dominant in its market. It's doing well out of ads. So over the longer term, it still looks compelling. But maybe for the moment, that rally in the share price has just run a bit too far.
Okay, thank you, Chris Beauchamp, for that. Wrapping up what we're going to expect as we enter the last week of April. So enjoy your weekend. It is St. George's Day, so have yourself some fun. And it's also the 400th anniversary of Shakespeare's death as well. So read a book or two. All right, goodbye.